Rob's child. Nothing I say is investment advice, and I have no intention to replace any content of security analysis, but to open it for discussion. This episode is about Chapter 42, starting Part 4 of the book. Part 4 is titled Balance Sheet Analysis, Implications of Asset Values. And this chapter, 42, is titled Balance Sheet Analysis, Significance of Book Value. It's a relatively short, somewhat simple chapter that brings up a few important points. But in the end, mentions that this whole chapter is mostly inconsequential. And we'll get to that point, I guess, at the end of the video. So we start with listing 5 purposes of using the balance sheet. Might as well go through them. So how much capital is invested in the business, number one. How well it's capitalized, how top heavy it is, how much debt they're going to be owing. And the rest of its capitalization structure. That's really number 3. Number 2, revealing ease or stringency of the financial situation, the working capital position. Number 4, a check on the validity of the reported earnings. And number 5, a basis for analyzing the sources of income. So we begin talking about how book value shouldn't include goodwill. And when I look at balance sheets, I always the first thing I check is how much of the total assets are goodwill, because goodwill it gives a sense of how confident people are in the business. It doesn't have any necessarily real value. And so the first thing he says is get rid of that, along with a list of other items he considers to be not really real sellable assets. When he's looking for book value, he's looking for the tangible book value. And luckily, that's a normal thing that you'll still find today on balance sheets, but we are missing a few items from it as well. Mainly the value of preferred shares. So the problem with this whole situation is that he says that oftentimes you find that preferred share value is not included in the liabilities. And, it has claim to money before the common shareholders, and that's kind of why he says that it should be, you should use an effective value of preferred shares. And a lot of times they have a supposed par value of just $1 or 0. And he says that's not a good thing and goes through examples of that. That's pretty much the biggest point of going through this whole chapter. I will mention, obviously, if you read this chapter, you may have been surprised, as I am, to find out that how conservative of a stance he has on book value, that, all the tangible assets minus all the liabilities give you, including the preferred shares, which is, like I just said, the part that's sometimes missing, at least, that is how you come up with the real asset value for the stock. If Graham were to go through balance sheets of companies today, he wouldn't find a whole lot. I mean, he would find companies. I have some companies that have their tangible book value minus liabilities. The stock's still worth quite a good amount of money, but in most cases today, you're not going to be finding that. But moving on, again, this whole chapter is all about book value. So we have a point here. Again, he's mentioned many times through the book about how book value used to mean everything, and now it doesn't really mean very much. As of 1940, it doesn't really mean much anymore. And then he says ordinarily, when you're looking at stocks, this is, summing up the whole chapter in a bunch of points, basically, that, it's not super useful unless he says it's in a really extreme case. And so he has a few examples in there where, if you were to buy the whole company, the value of it per share, is so ridiculously high that no smart person would buy the company based on that. But and then how companies can sometimes be devalued so much by their stock that it doesn't make any sense, because if you were to liquidate the whole thing tomorrow, there would be way more money left over for the common shareholders than what the value of the stock is. And so those are situations where it gets extreme, and perhaps opportunities to take advantage of. Obviously, in that case, he says he uses the term fleeting. Book value deserves at least a fleeting glance before buying and selling a stock. That it deserves to be examined before you totally reject it. But we'll get to that main point at the end. He says that, some of the things that are affecting book value being the stock price being way too above the tangible book value or lower than that. It has to do with, it can have to do with what's going on in the earnings. So if you have really high earnings, that can push it higher until there's competition or they run out of market share. There's no more buyers for whatever their product is. And then, then it might normalize after that situation. And then equally opposite, if you have an industry that's been beaten down and nobody wants to invest it for long enough, it it dissuades competition, and it can add value over time, and you can end up with that's when you can end up with especially situations where even if you were to liquidate the company, you'd still get more money than what the shares are selling for. And then he has a point here that small companies basically can rapidly increase their sales versus big companies. And so, if you're investing in a certain industry where it's been beaten down, you might as well get the smaller company, because they're going to be able to expand their earnings faster, so you'll get a much better capital appreciation than with a bigger company, as long as you're confident that the business is going to be coming back or expanding from where it is. But in the end of all of this, the main point that we get to at the very end is that the book value is pretty much moot and doesn't give you a complete picture as to what's going on. But he says you should always check it anyway, just to make sure you're, and I quote, acting sensibly. And this is something I do when I look at stocks. I always take a look at, again, they calculate book value today on balance sheets very differently than how Graham does it. And so moving forward, one thing I'll do differently is take a look at at least take a look at the tangible asset value and the liabilities, and see, if this company had to liquidate everything, would there be anything left for the common stockholder? Would there be a lot left for the common stockholder? This is something that you can obviously take advantage of. Or if you're looking at a company that's like beaten down in its price like so much that it can help you to take a look at these things and give you an idea if there is a lot more value there than what the market is pricing in. And equally, you know, I mean, book values today are not even, they're completely irrelevant. Let's pull up an example or two. So, one example, let's just pull up Tesla. Current price book value by how they value it now is 23. Um, so the value of all of their assets multiplied by 23, that's what you're paying for. You're paying 23 times the cost of all of the actual company. However, that includes goodwill, that includes everything, and it doesn't discount the liabilities. So taking a look over at the balance sheet, I might be wrong on this. See, I never checked net tangible assets. See, I'm looking at it now. Net tangible assets, it says is 44 billion, and their total liabilities is less than that. It's 36 billion dollars, around 36 billion. So I make fun of some of these companies with how high their PE ratios are sometimes. Right now, Tesla is at 76. But as far as, see, this is a good thing. This is a useful chapter. At the end, I'm thinking, oh, this is not very useful. He says, you just take a glance at it. It probably doesn't even matter anyway. But actually, this chapter is making me have a little bit of more confidence in a company like Tesla. So knowing that their net tangible assets, who knows? I don't know how they calculate that exactly. We could have a situation where their buildings and a lot of their tangible assets are even maybe overvalued, but that's not for me to judge. It's a much more solid balance sheet than I had assumed it had. So there you go. I'm learning something in all of this. So again, I want to finish this video with again to repeat the conclusion of the chapter, which states book value is basically moot, but you should check it anyway and make sure that you're acting sensibly. And this is in buying something or selling something. And that's it. Hope you enjoyed chapter 42, and I'll see you in the next episode. All right, Rob's Child.